The worst day for the Nasdaq since, my gosh, March, which is a time around when you were pretty public about the market as well. I'm curious what you think of this particular trade today. Is it just some market jitters at the beginning of September, or is this the beginning of the end?
Yes, it's certainly not the beginning of the end, but I would say we're coming upon one of the more uncertain periods in American history, right? We have a very divisive presidential election, coupled with a virus that's had a huge impact on the economy, and the markets have been remarkably strong since really the third week in March, and so it's not surprising. Valuations, particularly sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty, and we have an election in 60 days where it's a toss-up who's going to be the next president and what the policies of the next president, whether it's Trump's second term or Biden's first term, what that means for the country, what it means for corporate America, what it means for taxation. These are uncertain issues, and uncertainty, as I say, is the enemy of markets.
You had said that it wouldn't change your investment position no matter which person was to be president for the next administration. Are you changing your thoughts on that now? Do you think there would be widely different policies were there to be a Biden administration, for example, rather than a second Trump term?
I don't know that it's completely knowable. I think Biden and his choice of a vice president suggests a more kind of moderate as opposed to more progressive Democratic administration, to the extent that Biden is sort of the winner. But I do think they're going to have different policies and different approaches toward, taxation, business, et cetera. Although I do think Biden, Kamala Harris is in a more moderate camp than a Biden, Warren administration, for example.
I do want to push you a little bit on valuations, because you mentioned how things had maybe got a little fully valued or overvalued, but a DocuSign down 12%, Tesla down 8% today. Is that closer to sort of the real valuation for these companies, or a fair valuation in this environment? Or, could there be even a lot more to go?
So I don't know enough about either of those two businesses to know whether the price is a fair price or not. But a lot of, I would say, when I speak about valuation of some of the more high-flying companies, a lot is predicated on what's going to happen in the future, right? What's interesting is when you have a world with almost 0% interest rates, the discount rates used to discount the future are very, very low. And so with companies which are growing very rapidly, low discount rates, rapidly growing companies, you can get to very high valuations. Although the problem is small changes in your assumptions can lead to a very different outcome in terms of what a business is worth. And I think those small changes in assumptions can relate to someone's confidence in what the future looks like. And I think it's hard to predict the future when we have an uncertain sort of political environment and just the inherent uncertainty about the virus. Yesterday, CDC tells states to prepare for, possibly a distribution of a vaccine November 1st. If there's a real vaccine that's distributed in scale before the end of the year, that has a meaningful impact. If there isn't one until the second half of next year, that has a meaningful impact as well. I just think it's not known today, what those outcomes are, and you factor in. Your risk premium, should go up when there's more uncertainty, and the risk premium relates to the discount rate. It's the risk-free rate plus a risk premium that you use to discount the future. And many rapidly growing companies, you can't justify the value placing a multiple on next year's earnings, which is sort of the convention for many kind of more mundane businesses. You have to make certain expectations about a company's ability to become profitable, and for those profits to grow at a pretty rapid rate to justify many of the values or the collective values of where many of these companies were trading. And I think that is inevitably leads to more volatility when there's uncertainty.
And in some ways, there's more uncertainty now even than there was in March, when we knew less about how much there was to be uncertain about. Just base case-wise, coronavirus-wise, what are you looking at, Bill? And do you anticipate yourself going back into the office, or any of your staff going back into the office anytime soon?
Yeah, look, we'd love to get back to the office. Zoom is, humor doesn't work very well on Zoom. And if, part of a culture of an organization is how people relate to one another and the team. And we have regular, Zoom meetings, but it doesn't compare to the camaraderie that you can develop, in an office environment. So we'd love to get back. At the same time, we've worked very effectively working from home. We don't want to create any risk for our employees, and the nature of our business is one that we don't need to be in the office, at least in the short term, in order to be effective. So we haven't picked a date yet. We're kind of taking it day by day, but we have no current plans to come back to the office, I would say, this winter, and hopefully, we'll get back there as soon as possible. I do miss the office, do miss physical interaction with the team.
I do want to mention that one analyst in the UK labelled your February trades literally, and I'm quoting, arguably the greatest trade witnessed by the UK closed-end industry. Obviously, we witnessed it here. Are you trading this market on down days like this, and we haven't had one in a long time? Are you considering, or are your managers considering sort of derivative type trades or hedge type trades?
Yes, no, we're not trading at all. I mean, we're not doing anything. We own, 9, 10 companies. We like the businesses. We're comfortable with their valuations. And we have pretty full positions in each of them. So we're not adding on a day like this, but we're not subtracting on a day like this. We like the companies we own. We think they'll do very well. And we don't put them in the overvalued camp. So I guess.
None of them?
None of them. No.
Are even fairly valued yet?
Absolutely not. Definitely.
And that's, let me remind people, with a 46+% year-to-date gain and they've all really been sort of in your portfolio on a 59% gain last year. So let's get to the SPAC, Bill. It's only been 6 weeks. You have a couple of years, really, but we know that there have definitely been conversations, due diligence being done, and we reported yesterday that Airbnb was said to have rebuffed an approach from you. Explain what that all means, how it all went down.
Sure. I wouldn't use the word rebuff. And, we've had a very nice dialogue with Airbnb. We got to know the management team or a number of the senior members of the team. It's a business that we've admired over time. They've been on a path to go public. We talked a bit with them about our structure, and I think they have not, as your article pointed out, they haven't decided against going the SPAC route. But at this point, I think their first choice is to do an IPO. Putting aside Airbnb, just speaking generally, what we offer to a company is the ability to inject, $5 billion of cash, take them public. If we started today, if we opened a due diligence, we got access to a data room on a company and had opportunity to spend time with management by Zoom, when I would say in 3 to 4 weeks, depending on the nature of the business, we could get a sufficient understanding of the business to be comfortable. And we could also negotiate a deal, and we could give them certainty on raising capital, and they could become a public company, 45 to 60 days after that initial 30-day period of time. But we give them certainty, if you will, in the first 30 days. A company like Airbnb is filed confidentially. At some point, they're going to file their prospectus. Sometime in December, maybe after the election, possibly before the new administration comes in, it's really that last day of the roadshow that they'll know what price they get and whether that's a certain transaction and how much capital they raise. It's a different approach. You're sort of, you're taking behind door number 3 as opposed to the bird in hand, so to speak. And I guess we did not get to a stage where we had access to inside information. We had the ability to do real due diligence on the business, or did we have any opportunity to discuss valuation with Airbnb? We really kind of a get to know you. I think the reports are true that we've had some discussions, but they were very preliminary, and we did not discuss valuation, and we didn't get to do a deep enough dive, frankly, to determine whether this is a business we'd want to own and at what price we'd want to own it at. So we like the company, at least from the outside, in terms of the nature of the business. We don't know enough about the economics of the business or the way it's run to have a view as to whether it's a fit for what we're trying to do.
Just from their point of view, Bill, and obviously the certainty of the price that they would get is a big plus, right? It's a big thumbs up for that. But otherwise, and given that they would have to give away something in order to go the SPAC route, right? They would definitely very much have to let you have a big say in how they run the business. What would be in it for them to go the SPAC route, given that, their board is full of people like, Ken Chenault and Greylocks, Reid Hoffman and so on? There's plenty of advice there.
Sure. So actually, we're not insisting on a particular role for Pershing Square or any member of our team or any of the directors on the Pershing Square Tontine board. Obviously, the governance of whatever company we merge with is an important topic, and we're going to want to make sure it's a board that has appropriate independent representation. But we're not requiring that Pershing Square, necessarily has a seat on the board. It really depends on the situation. It depends on the existing board. The last SPAC transaction we did, many years ago, 8 years ago, was Burger King, and a couple of directors from our SPAC at that time joined the board, but I did not personally. Excuse me. And it's been a very successful experience. So I think maybe there's some misconceptions about SPACs sort of generally, but in our case, you don't give up anything by doing a deal with us. And you get to figure out everything up front before you sign the papers and before you even have to tell anyone you've begun your process. So I think what's attractive about what we are offering is the ability to give certainty in a very short period of time. A $5 billion IPO is a very large IPO. Other than Alibaba, Facebook, and Uber, there has not been a $5 billion plus IPO in the U.S. for the last decade. And so if you're a large company that wants to raise a large amount of capital, today is sort of a perfect reason why you don't want to just, I think while markets are $1 billion, maybe people get excited they'll get an overvaluation, if you will, in an IPO transaction. Maybe that's why that route makes sense. But you don't know until the last day of the IPO process whether your transaction gets done or not. And that's why we've had enormously, let's put it this way, we weren't rebuffed by Airbnb, but I would say we've certainly been welcomed by a meaningful number of kind of private equity controlled companies. We're in a number of discussions, also preliminary, as well as I would say family or individually controlled companies. We were doing work on various businesses, getting to know management teams, and I'm quite confident we're going to find a transaction that makes sense for us and a transaction that makes sense for the other side. But in a volatile market, the reason why we launched Pershing Square Capital in this market was our expectation was volatility to come, and certainty and a $5 billion injection of cash is something I wouldn't walk away so quickly from. If our positions were reversed and I was the CEO of a private company that needed to raise a lot of cash to go public and had to do it within a reasonable time frame, I would take a very hard look at what we offer.
Well, then, Bill, let me ask you why you might be so interested if there are certain problems in a volatile environment. And we all know that criticism is leveled against Airbnb, right? They had to raise $2 billion at the beginning of the pandemic. Brian Chesky was even sort of called upon to step down at an early point in the pandemic. Why would you be so interested in this business if it is such a volatile business? And yes, you know a lot about tourism and about travel and hotels and stuff, but what would be your confidence in this business?
Look, again, we have not done the work on Airbnb. We've not had access to inside information. We're looking for, our favorite businesses in the world are sort of asset-light, annuity-like businesses that can grow at a high rate over a very long period of time with a lot of durability. To the extent that Airbnb meets those criteria and it's managed well, it has a control over its cost structure, there's a path to meaningful profitability and cash flow generation, then it's a business that meets our criteria. If not, it's not a business that meets our criteria. And the companies that we're looking for, what I would describe as very, very durable, growth companies, will accept a degree of volatility. We were buying Hilton stock, in the depths of the market in March, even though the hotel industry is really on its knees because we've got a long-term view on the industry, and we haven't sold a share of Hilton that we've acquired, and we now own just under 5% of the company. So we like businesses where, if you will, you own a royalty on future growth and travel. That's appealing to us. But there are many other kinds of businesses we're looking at in the, call it fintech space, as well as some consumer businesses, some sort of B2B, companies, kind of a full spectrum of different businesses, and we're trying to find a fit between what we offer and what will be of value to a counterparty. But I do think market volatility is our friend. Interestingly, Pershing Square Capital, I noticed today, was either flat or slightly up for the day in a down 5% market. And I think what the market's saying is this entity becomes more valuable with greater uncertainty. It's now trading at about a 10% premium to the cash that we have in the till, and it's worth a premium to the cash because the worse the world gets, in a way, the better the deal will make in terms of merging with a company.
I mean, there were definitely some fintech and financial companies, being talked about in the earlier days when people were talking about this, including Bloomberg LP, which, you can comment on if you want, but also the likes of Stripe, for example, or, Klarna, or some of those. Is that the type of company that you feel would be a good candidate for your SPAC?
Sure. So while I'm on Bloomberg, might as well talk about Bloomberg. I mean, this is a business I've obviously known a very long time. I became a Bloomberg customer in October of 1992, and I've never canceled my subscription. And we have many more today than we had, if you will, back then. So it's a business I certainly admire, and it's a great company, and it's certainly a fit within the kinds of businesses that we would be interested in. Stripe. I have a very high regard for these co-CEOs or CEO and presidents, the brothers that run. Carlson brothers that run that business. I think they're building a remarkable, kind of franchise. I do like that company. I think, my sense of Stripe today, and actually we have had very limited discussions with Stripe. They're not yet ready to go public. So one of the other criteria for us is the company has to really be ready to be a public company today. It has to be a great business. It's got to be a durable growth company. It's got to be managed well. They have to have, a path to, profitability. And they have to be ready to be a public company. And there are certain requirements in terms of management and infrastructure and systems that you need in order to be a public company.
That said, Bill, most of the chatter has discussed really Silicon Valley, partially because you used that kind of language when you were talking about what you were looking for. But are you also looking at a whole range of other things? I mean, are you looking at some industrials? Or are you looking at parts of companies, assets of different companies and so on?
Yeah, so I would say the highest probability transactions in the biggest universe is, I would say, the private equity controlled universe. The private equity firms are very comfortable doing transactions with SPACs. They understand the certainty and the other benefits, and they understand how to think about, transaction value. And so we have a number of discussions going on in private equity. Actually, you had mentioned earlier in the conversation, I think what's changed. Private equity, I think, has always been open to transactions with SPACs. I think the biggest change in the last period is that the whole sort of venture-backed community is totally open to SPAC transactions today. There was, Bill Gurley, one of the general partners of Benchmark, wrote a great compare and contrast between IPO, SPACs, and direct listings. I encourage you to take a look at. And actually, in the last day or so, Reid Hoffman, a member of the Airbnb board, announced that he was raising a SPAC. There's a guy named Kevin Hartz, who's one of the early sort of angel type investors. So I do think the SPAC structure has kind of come into its own. Obviously, we have a view about the benefits of our structure versus the typical SPAC structure, which has led to our scale and the fact that we have the least amount of dilution, the least amount of friction to do a transaction.
Well,
I do think we're changing the way companies are going to go public, and that's probably a good thing. Good for capital formation, good for making it easier for businesses to raise capital. I think that's inherently positive.
And as you say, it's partially, market concerns. I mean, no one wants down rounds, right? So venture capital has to find some other way of having their businesses funded and so on. Bill, we don't have much time left. I want to very briefly ask you about Fannie, Freddie, and the rest of your portfolio before we move on to an idea you have for young people, for children, in fact. But do you anticipate any problems with Fannie, Freddie going forward? This argument that just won't go away, about capital rules?
Well, so I think Fannie and Freddie are clearly on a path to becoming privatized companies, and all the necessary steps are in the process of being taken. One of the significant ones is finalizing a capital rule, and I think we're getting closer. The new version of the capital rule is improved. I think the amount of capital that has been proposed for Fannie and Freddie at 4% of assets and off-balance sheet guarantees is well above what they actually require. And the problem with that is it's going to make it difficult to raise a sufficient amount of capital for these to emerge as truly privatized companies. And mortgage rates are going to have to go up. Fannie and Freddie wrote kind of responsive letters about the capital rule, and they point out, in order for investors to invest in Fannie and Freddie, particularly in light of the history of the government expropriation of the two companies, investors are going to have to earn an adequate return on the capital that they invest in order to invest. And it becomes really almost impossible to do so if capital levels are set at levels, that are well beyond what the business needs. So we think Fannie and Freddie are comfortably capped, more than what Jamie Dimon would call a fortress balance sheet at 2.5% capital to total assets. Banks have to hold 4%. against their mortgage portfolios, but banks actually hold mortgages on balance sheet. They're not. Fannie and Freddie are really just guarantors of timely payment of interest and principal on a portfolio of very, very low risk securities.
Yeah.
And they have a much better franchise than banks in terms of annuity-like cash flows they collect. So I think that stuff's going to get worked out. And really the next step is resolving the government preferred stock. And our hope is that, 2021, Fannie Freddie reemerge as truly independent public companies, taking the risk away from the taxpayer. And I think that's important, particularly as we've seen in the pandemic. The first people to withdraw from the financing markets were the sort of the quasi, the traditional private sector, whereas Fannie and Freddie kept guaranteeing mortgage securities and providing liquidity to this very important market